Welcome to the jungle, the stock market. Booyah! You want to be a stock market whiz? You're in the right place. Let's break down this beast so you can rake in the dough. The stock market is like a giant flea market, but instead of old lamps and vinyl records, we're trading pieces of companies. These pieces are called stocks or shares. Think of it as owning a tiny slice of your favorite pizza joint. The more slices you own, the bigger your say in the company. The stock market is where these trades happen. It's a whirlwind of buying and selling with prices going up and down like a roller coaster. Don't worry, we'll navigate this roller coaster together. Remember, knowledge is power. This isn't some get-rich-quick scheme. It's about investing in companies you believe in, companies that are making a difference. It's a long game, people. But with the right knowledge and a little bit of guts, you can be shouting booyah from your yacht one day. So, buckle up because we're about to dive headfirst into the exciting world of stocks and shares. Get ready to learn, earn, and conquer the market. Stock market. Lingo, know your ammo. Understanding the language of the stock market is crucial for any aspiring investor. Just like a soldier needs to know their weapons, you need to know your financial terms to navigate the market effectively. Before you storm the stock market, you gotta know your ammo. This means familiarizing yourself with the key terms and concepts that will help you make informed decisions. Without this knowledge, you might find yourself lost in the complex world of trading. Let's break down some key terms. These are the building blocks of your stock market education. Understanding these will give you a solid foundation to build upon as you delve deeper into the world of investing. Stocks or shares. Think of these as ownership certificates in a company. You buy a share, you own a piece. This means you have a claim on part of the company's assets and earnings. The more shares you own, the greater your stake in the company. Publicly traded company. This is a company listed on a stock exchange, meaning anyone can buy its shares. Think Apple, Amazon, your favorite sneaker company. These companies have gone through a rigorous process to be listed, making their shares available to the public. Stock exchange. This is the marketplace where stocks are bought and sold. Think of it like the stock market's trading floor, but online. The New York Stock Exchange, NYSE, and NASDAQ are major players. These exchanges provide a platform for buyers and sellers to trade shares, ensuring transparency and fairness in the market. Market capitalization. This is the total value of a company's outstanding shares. Basically, how much the whole company is worth in the market. It's calculated by multiplying the current share price by the total number of outstanding shares. This metric helps investors understand the size and value of a company. Dividends. These are your share of the company's profits paid out to shareholders. Think of it as a bonus for being a part owner. Sweet. Companies that pay dividends are often seen as stable and reliable, providing a steady income stream for investors. Bull market. This is when the market is on fire. Prices are going up, everyone's making money. Time to ride the wave. Bull markets are characterized by investor confidence and optimism, leading to increased buying activity and rising stock prices. Bear market. This is the opposite of a bull market. Prices are falling and investors are running for cover. Be careful out there. Bear markets can be challenging, but they also present opportunities for savvy investors to buy undervalued stocks. Now you're talking the talk. Remember, knowledge is power in the stock market. Keep these terms in mind as we move on to the exciting part, how to play the game. With a solid understanding of these key concepts, you'll be better equipped to navigate the ups and downs of the market and make informed investment decisions. Buying and selling, how stocks work. All right, enough with the fancy terms. Let's get down to business. How do stocks actually work? Imagine you've got your eye on that hot new tech company, Techtastic. They create cutting-edge gadgets everyone wants. You believe in their vision, you think they're going to be huge, so you decide to buy some Techtastic stock. Buying a share of Techtastic means you're now a part owner, even if it's a teeny tiny part. Now, the price of a stock isn't set in stone. It changes based on two main things, supply and demand. If more people want to buy Techtastic, high demand, the price goes up. If more people want to sell, high supply, the price goes down. Think of it like a bidding war. You put in an offer to buy at a certain price and someone else decides to sell at that price. Boom! You're now a proud Techtastic shareholder. But remember, the stock market is a living, breathing thing. Prices fluctuate constantly based on news, rumors, and even the gut feelings of millions of investors. That's why we do our research and invest in companies we believe in for the long haul. Common versus preferred stock, picking your fighter. In the world of investing, choosing the right type of stock is crucial. It's like picking the right tool for the job or the right flavor of ice cream for your taste buds. Now let's talk about the different types of stocks you can buy, common and preferred. Each type has its own unique characteristics and benefits, and understanding these can help you make a more informed decision. Think of them as two different flavors of the same ice cream. Just like you might have a preference for chocolate over vanilla, you might find that one type of stock suits your investment strategy better than the other. Both are delicious, but one might suit your taste buds better. Similarly, both common and preferred stocks have their own appeal, and the right choice depends on your personal preferences and financial goals. Common stock is like your classic vanilla ice cream, the most popular choice. It's the go-to option for many investors because it offers a good balance of risk and reward. When you buy common stock, you get voting rights in the company, usually one vote per share. This means you have a say in important company decisions, such as electing the board of directors or approving major corporate actions. You also have the potential to earn dividends, which are like sweet, sweet cherries on top of your ice cream sundae. Dividends are payments made by the company to its shareholders, usually from profits. Preferred stock, on the other hand, is like your fancy pistachio ice cream, a bit more sophisticated. It's often chosen by investors who are looking for a more stable and predictable income stream. Preferred stockholders usually don't get voting rights, but they get paid dividends first. This means that in the event of a company making a profit, preferred shareholders are the first to receive their share of the earnings. They also have a higher claim to company assets if things go south. In the unfortunate event of a company going bankrupt, preferred shareholders are paid before common shareholders. Think of it as having a VIP pass. This higher claim to assets and priority in dividend payments can make preferred stock an attractive option for more conservative investors. So which one is right for you? The answer depends on your individual investing goals and risk tolerance. Are you looking for growth potential or stability? It depends on your investing goals and risk tolerance. If you're comfortable with taking on more risk for the chance of higher returns, common stock might be the better choice for you. If you want voting rights and the potential for higher returns, common stock might be your jam. It's a good option for those who are willing to ride out the ups and downs of the market in exchange for the possibility of significant gains. If you prefer steady income and lower risk, preferred stock could be the way to go. It's ideal for investors who prioritize a reliable income stream over the potential for high returns. Remember, there's no one-size-fits-all answer. Every investor is different, and what works for one person might not work for another. The important thing is to understand the difference and choose the flavor that best suits your investment palette. Take the time to research and consider your options carefully, and don't be afraid to seek advice from a financial advisor if you need it. Diving in your first stock market play. This is an exciting moment, but it's important to approach it with a clear strategy and a calm mind. Ready to jump into the stock market pool? The thrill of potential gains can be exhilarating, but remember, preparation is key. Hold on. Before you do a cannonball, let's make sure you're prepared for a smooth and successful swim. Step 1. Research. This is the foundation of any good investment strategy. Don't just buy any stock because it sounds cool or your neighbor's brother-in-law told you it's a sure thing. Do your homework. Investigate the company's history, its market position, and future prospects. Look into companies you're interested in, understand their business, check their financials, read their annual reports, understand their revenue streams, and look at their profit margins. Next up, diversification. Don't put all your eggs in one basket. This age-old advice is crucial in the stock market. Spread your investments across different industries and companies. This strategy helps mitigate risk. This way, if one sector takes a hit, your entire portfolio won't go down the drain. Diversification is your safety net. Now, are you in it for the long haul or looking for a quick buck? Your investment horizon will shape your strategy. Long-term investing means holding on to stocks for years, allowing your investments to grow and compound over time, riding out the market's ups and downs. Short-term trading is riskier, requiring more attention and quick decision-making, trying to make quick profits from short-term price fluctuations. Choose your adventure wisely. Each path has its own set of challenges and rewards, and most importantly, understand your risk tolerance. This is a critical aspect of investing. How much are you willing to lose? Investing always involves risk, but knowing your limits will help you make smarter decisions. Assess your financial situation and set clear boundaries. But knowing your limits will help you make smarter decisions. This self-awareness can prevent panic selling and impulsive buying. Finally, you'll need a broker to execute your trades. Brokers act as intermediaries between you and the stock market. These days, there are tons of online brokerage platforms that make it easy and affordable to buy and sell stocks. They offer various tools and resources to help you make informed decisions. Choose one that suits your needs and budget. Look for platforms with low fees, good customer service, and a user-friendly interface. Happy investing. Risks and rewards? Don't bet the farm. Now let's talk turkey. The stock market can be a wild ride, full of exhilarating highs and gut-wrenching lows. It's crucial to understand that investing always involves risk. Even if you do all your research and invest in solid companies, there's no guarantee you'll make money. Market conditions, economic downturns, or unforeseen events can impact stock prices, sometimes dramatically. That's why it's crucial to never invest more money than you can afford to lose. Don't bet the farm. Start small, learn the ropes, and gradually increase your investment as you gain experience and confidence. Remember, investing isn't gambling. It's about participating in the growth of companies you believe in. It's about building long-term wealth through careful research, diversification, and a healthy dose of patience. Don't get swept up in the hype or make impulsive decisions based on emotions. Stay informed, stay disciplined, and remember that slow and steady wins the race in the stock market.